Good morning, everyone. This is Darius here to present our macro bundle Q&A live for Wednesday, December 15th, 2021. It is Fed Day. We got a lot going on in financial markets. Obviously, a lot of volatility out there if you're not overweight high beta exposures and bonds this week. So I've got my friend Nadine Terman from Solstein Capital joining us today. How you doing, Nadine?
Hey, Darius, it's Fed Fun Day today.
Yeah, no, the Fed has been a willing you know who the Fed is? The Fed is that person who drops out of high school but still hangs around the town and tries to get all the kids high on weed. Like
Like
that's who the
poking the
Fed is.
bear. I think it's somebody when you're camping, like poking the bear.
Exactly, exactly. And now the Fed has to, kind of go to the military and
Yeah, yeah.
comes back and
Shape
is
up.
changed man and is not dealing pot anymore. And so I think a lot of investors are going to find out what investing is like on the other side of a $120 billion a month QE environment next year. Obviously, that's that's an understatement if I've ever made one. Yeah. So what's top of mind with you, Nadine? Obviously, you got a lot going on. It's year end for you, your institution. Kind of give me your thoughts on how to navigate that transition into the next year.
Well, I'm just, I was looking at your materials today and I was thinking, gosh, you and I have known each other for a long time, but
Mhm.
for some of your clients who may be less familiar with your work or when they're thinking about risk management, maybe you could walk a little bit through the four horsemen and what should people be looking for? And are you caring about one signal? Do you need, all four horsemen to be riding? How do people think about this?
I'll start by saying I don't think there's a perfect answer in anything that we do as investors or risk managers or both. But I do believe there are tools that you can use to give yourself a higher probability of chance of not making a mistake than otherwise, obviously of not using the tool. And so when I look at something like the four horsemen of market risks, we obviously taking it to the chart here. We have the VVIX VIX ratio, the high beta, low beta ratio. Again, this is these are high beta stocks in the U.S. equity market as a ratio of low beta stocks, small cap stocks relative to mega cap stocks, and then value to growth. And the reason I think these ratios are so important and so critical is because the world changes from a style factor perspective whenever you sort of cross the line from Goldilocks and reflation into inflation and deflation. And so that's sort of what part of that's the main primary reason we look at these ratios is because it tells you sort of what the market is thinking on an internal basis because oftentimes phase transitions, as we've seen, calling out the mini reflation trade going back to September, and obviously calling out the pivot back towards inflation or stagflation in early November and making a lot of sales then, those ratios tend to be leading indicators of broadening market activity. And particularly when you're going into something like a big major drawdown or market event risk, you typically see all four of these ratios are bearish together or bearish simultaneously in something like a major market drawdown. Q418 being the most, or the Q418 in March of 2020 being the two most recent ones. And so part of the reason we made the discussion or we made the statement going back a few months from now, we said, hey, look, when all four of these things are bearish, we're going to have to materially pivot our one, the types of exposures we're long, but more importantly, the amount of equity and commodity type risk, the amount of risk asset risk we're taking in the portfolio construction. Now we've already done a tremendous amount of that. We've raised cash up to 40% cash in the past sort of kind of 6 or 7 weeks in terms of the sales we've made, but it hasn't necessarily been all out of higher beta assets. Hasn't necessarily been out of well, actually, we are out now fully all out of commodities, but a lot of that cash is just waiting to buy bonds. It's not necessarily saying, hey, look, we think the market's about to crash today. It could very well be on, on its route to crashing. And I believe these ratios will give us the final look see on that.
And I talk about it, and some people understand the volatility of volatility versus volatility. Maybe just walk through that because I think people can get high beta versus low beta, small versus mega cap, value versus growth. Maybe just walk through the first one for people so they understand when that is in a bearish formation. What does that mean?
Yeah, that's a great point. So when the VVIX VIX ratio goes down in its own price, what typically is occurring is that the VIX itself is rising faster than the volatility of volatility. So the price of upside calls on the VIX, for instance, that people tend to reach for and kind of use hedge their portfolios, tends to stop rising at a rate once volatility actually starts spiking in the front month contract. And so if you think about this from a investor psychology or behavioral perspective, what it really means is people go from generally hedging to saying, "Oh, poop, I really have to, protect my livelihood, have to protect my nest egg, and do some more do some more damage in terms of hedging at the front month of the structure and then kind of bidding the VIX up." So that's what you typically see. And the reason we look at it in a ratio basis is because it sort of creates bounds with respect to the overall range. Like, right, you can use the VIX in isolation, but there's the reality is, we've seen a kind of a material stair step higher in the lower boundary of the VIX since, I would say, the beginning of 2018. And so you never really truly understand where you are at the lower boundary of that threshold. In so much as, prior to prior to 2008, we had never really seen a VIX 80, and clearly we were looked like we were on our way to VIX 100 last March. And so there's really no thresholds that you can use as a probable boundary, but this allows you to some degree, this VVIX fixed ratio kind of puts a little bit of a bound around it to understand, hey, it's not going to go too much higher from here or too much lower from here.
To some of the questions in a second, but then maybe, bring it also to the CACRI chart, because you
Mhm.
got 3 out of the 4 signals look bearish here, right?
Mhm.
And then the CACRI is saying, hey, people are consensus fear zone. So
Yep.
maybe put those two things together for people.
Yeah, no, this is one. I would say this is one of the one analysis in the toolkit. Not the one analysis, but it's certainly something in the toolkit that is sort of leading me from sort of walking off the cliff, if you will, in terms of being a full on max bear. Because the back test, if you look at each of these times we've been in CACRI since the start of 2015, you generally get paid on a 1 month forward basis to take risk, to take
Yeah.
increase your exposure to risk assets. That's certainly something we've seen. And again, it's not a 100% back test. You're around 70% for something like the S&P 500 or emerging market equities. You're a little bit over 60% or around 60% for something like commodities and Bitcoin. But generally speaking, risk assets tend to do really well on a 1 month forward basis when you're in these things. The problem is that 30%, right? That 30%, you go into CACRI and it goes into consensus fear zone in October 2018. And by December 2018, you're down 25% buying the spot. And
Yeah.
same thing with going into the consensus fear zone kind of in the early part of March of last year. Like, sure, the market was up on a 1 month forward basis, but that wasn't before another additional, 2,000 basis points of downside. And so to me, that's also a signal in and of itself. What we're trying to do is help investors play the probabilities, especially when they're kind of more leaning in your favor, i.e. something like a 70% percent positive ratio is very clearly leaning in your favor to take risk. You just have to be aware in the context of all the other signals that the process is generating, transitioning from inflation to deflation. Four horsemen are, 3 out of 4 bearish and persistently bearish. There's obviously a lot of other stuff going on with respect to monetary policy that, we've had some industry leading views on as well. So, I think we have to take it all together and kind of have to be a human to, kind of understand at which things to weight at various points in the cycle.
And before we move on, I've got some questions on China and the like. I want to go to Joel's question, and he's saying, in reviewing the 4 horsemen, are we closer to a couple bearish to neutral transitions or neutral to bearish transitions in the lone holdout?
No, no, we're definitely closer to being bearish in high beta, low
Okay.
beta ratio. That's for sure. I think if we get another couple of days like what we're seeing today, got high beta down over 1%, low beta up,
Yeah.
about 30, 40 basis points the last time I checked. You're going to start to see that thing tilt bearish. And again,
Sure.
we've already raised 40% cash.
Yeah.
We did a good job of reverse managing some of the higher beta exposures out of the portfolio construction, starting in early November and obviously concluding on Friday last week. So, a lot of a lot of the process we would have undertaken to get us to this point has already been taken. It's not necessarily
Yeah.
we weren't trying to do that, but it just so happens based on the signal.
But also maybe the question from Joel gets to, like, do you buy the dip, right? So if you're going from the bearish to the neutral, then you're getting paid for people to unwind their bearishness or their defensiveness,
Yeah,
right?
no,
Versus if it's the last guy who's going to go down, well, then you're going to either like stay bearish or put more protection on.
yeah, no. So in answer the question, do you buy the dip? I mean, it always starts and ends with our grid regime backtest process. It's what are you buying the dip in is the real question, right? Like, I mean, we can all go sort of, buy the SPY and buy 60% SPY, 40% TLT and call it a day. Like that's, clearly we're not here to do that. So, there are times when that probably should be the investment recommendation for most investors, including ourselves. But there are also times where that's probably not a very good idea. So it's again, what are you buying the dip in? And what we've been trying to help investors understand with the help of these visualization tools is find out the kinds of things that make sense to be long in the current regime that'll also continue to make sense to be long in the pending regime. So, for example,
Staples, utilities, right?
mhm,
It's Rust, real estate, utilities,
Russ,
staples. Sometimes it's communications, as long as they're not too levered, and even
yeah,
healthcare, right? So you've got, we call it the Rust plus H. That's
yeah,
what you tend to
absolutely.
have. Hey, let me get a question to George here. You made the call into bonds early with the strong correlation between bonds and gold. Like, would you load up on GDX in the dips, or any kind of people like Franco or other kind of gold related companies maybe that have less beta, or do you need to wait for the gold?
Yeah, no, gold is annoying the heck out of me. It just it's not performing the way you would expect it to in the context of the sort of the tightening of the yield curve that we've seen. We've
Yeah.
seen a decent amount of flattening in the yield curve, and traditionally gold has historically performed well in those kinds of environments because obviously those kinds of environments tend to be sort of coinciding with economic slowdowns, inflation slowdowns, tighter monetary policy, all the things that have historically perpetuated higher gold prices. And so, in terms of do I want to go buy gold miners as a higher beta levered bet on top of my already sort of long gold exposure, the answer is very much no. But the real answer, going back to,
The
yeah,
answer's
yeah,
no.
absolutely. The
George,
real
don't do
answer
that
is
now.
this:
Yeah.
high beta as a style factor is the worst performing style. I think what's happening in this last few weeks in the market is somebody very big, it could be our friend Sir Kensington Griffin III, said, we are done with high beta as a style
They
factor.
take it off.
And we're
Yeah.
taking it off of everybody's book. If you're overweight high beta, sorry, that sucks for your bonus. But guess what? We're getting out of it. And that's exactly who published these charts 2 months ago. Like,
Yeah, yeah,
I'm
yeah. It
joking,
feels
but I'm
like
not
it,
joking.
right? Yeah, it feels like
Yeah,
that's what's going on, especially on
yeah,
Fridays. And that was George's
exactly.
question.
So
But
that
here's
I
a kind of related question, though, Darius. Sorry, and it's from John about long-term bonds and where do you enter? We were hoping on the 10-year to get to 1.6. I don't think we're going to get there to be entering. So do we? How do you let people know if they haven't built positions to start nibbling in?
Yeah, no, I think you got to start nibbling in, and depending on what the Fed does today. I mean, my hope, knock on wood. I mean, hope is not a risk management process, but I'm hoping that he says something uncomfortably hawkish. At least one thing, we get bond yield back up 3 or 4 basis points on that move, and I think you got to buy him. The market is what the market is. The market is trading like everyone is overweight high beta, and nobody has a bond in their portfolio. You know what I mean? In terms of not letting people out of high beta exposures and not letting people into fixed income and into long duration assets, that's exactly what the market's trading like. The market is designed to piss off the max amount of people at the most amount of time. And so I think that's exactly what's happening right here. So I don't know that you're going to have a lot of time to wait to buy bonds. So we'll start to increase allocations there over the next week or two, if we don't get some better prices.
And Tom Bonner's got a question. CNI loans turned up in November, ECRI leading index as well. What's your takeaway in light of your inflation to deflation projection? Does it indicate banks might not perform as poorly as expected? Is it a shallow deflation with the risk going to, it'll trade more like Goldilocks? Or, as you said, stop looking ahead, Tom. Well, you have to look ahead, but I think his point here is, we've seen it when there's narrow quad fours that trade, deflationary environments that trade like Goldilocks. Um, Obviously, you have to look at not just a couple of pieces of data, but a lot of data. But folks who are trying to plan for the top-down macro view, how do you answer that question for them?
Yeah, I think it's an excellent question. I mean, that's why I spend all my day just sort of going back and forth with institutional investors on data points like that. It's like, hey, this did that. How does this impact your process? Does this change your
Yeah.
thinking on something at all? And so it's a very reasonable and thoughtful question. I'll take it back to the slide deck as well. We've called out the post Delta bounce. I mean, we started talking about it in August. We said, hey, look, Delta slowed economic activity below kind of what current potential probably should be. We're probably going to see growth continue to slow through the month of September. And then we said, hey, look, it'll probably bounce through at least, the first couple of months of Q4. And
Yeah.
that's by and large what we've seen. If you just look at the color coding of this chart, you've seen ISMs go from light green to dark green again. You've seen something like jobs, kind of the job diffusion indices go light green to dark green again. So that's exactly what happened. But as it relates to what you should be doing with respect to your portfolio, you got to take it back to this chart. The market doesn't live in what's being reported. The market lives in what's going to get reported. And if you think about, where our model's projecting what's going to get reported, it's a sea of it's a bunch of I's transitioning to a sea of D's. Now, could you get a one-off data point here or there that kind of bucks the trend? You always do. I mean, that's the whole point of having a full nowcasting process that looks at all the various components of the economy and all the various different low and high frequency and soft and hard data to understand where those divergences are occurring. But generally speaking, what is the direction of travel for most of the growth and inflation statistics?
Go back to the chart that shows what does well in inflation and deflation, that stock, the dot plot. David is, and he's asking here about housing stocks, whether it's ITB or XHB. How do those do in your inflation and deflation environments?
Yeah, they're not represented on here, so that's a miss. So I got to make sure I put that in there eventually. But again, I just as soon not be long anything high beta. So if you're going to get long housing stocks, make sure you're long the slower growing, lower more dividend yieldy versions of that. Because again, a lot of what we're showing here, obviously showing the broad mainline sectors as well, but we're also showing all the different style factors as well. We're showing the ETFs in terms of like XLV, but what we're back testing is the actual underlying indices. And so when you see SPHB, we're back testing the S&P 500 high beta index. And so what you can also do when you don't see something that you're long or short or want to get long or short explicitly represented in these dot plots, that's not the end of the world. You can actually say, hey, look, I want to be long a housing stock that's high beta. Well, I know high beta is a bad style factor, so it might get caught up in Sir Kensington's high beta trade this week, right? But if it's a lower beta housing stock, it's probably caught up in Sir Kensington's desire to get long low beta. And so you think about it through the world through the style factor lens, especially when you are in inflation and deflation. Your stock picks work here. I should put top 5 and bottom 5 equity sectors up here in this chart because that's when your stock picks work. When it's inflation and deflation, it's all about style factors. And I think investors are relearning that lesson over the last 4 to 5 weeks.
Software. I'll let you know on ITB and XHB in a second. But just a clarification, Joel said his question on the four horsemen was more in the realm of, are the VVIX to VIX ratio and the value to growth ratio closer to going neutral than high beta, low beta is to bearish? And I think you answered it though, which is like, no, those are bearish, and it's just more probable or more likely that the high beta to low beta is going to go the other way.
I would answer the question with something I learned from my friend Laxman Atuchin over at Equity. Don't predict the predictors. This is a leading indicator. So if you're trying to front run the leading indicator, that you're going to create a lot of sort of subjectiveness in your process. That's clearly going to start to rely on more qualitative signals, what you're reading on finance Twitter, what you're reading in your inbox, what you're hearing and observing on CNBC or Bloomberg, in terms of trying to predict if this is going to go back to neutral or bearish. Just observe it and react to it. That to me is the better option. That's the more higher probability option in terms of compounding returns.
And I think get to the question, I'm just looking at ITB here. The low end of our trading range is $77, well, 77.01, and the high end is 84.61. So it's middle of the range, but you've got almost 2-to-1 upside to downside. So 6.1% upside to minus 3.4% downside. So just if you didn't do the top down, but you were looking at what is the trading range, that's asymmetries in your favor. It's got 28% implied volatility premium. The short and intermediate term lines are bullish and they're trading above those lines. So that's not, although the volume has been down. So maybe that's just also, Wells Fargo came out and said, their clients pulled out a record amount of liquidity, right? And so that liquidity may come in, that liquidity may come back in, and that would, bring something like this back. So you have to look at the top down, but also what's the asymmetry in what you're looking at.
Yeah, absolutely. That was phenomenal, by the way. And two, can we unpack what you just said? You said Wells Fargo said their clients put out a record amount of liquidity. Are you talking about?
Well, in terms of they pulled it out, they're sitting on cash, right? So they're just sitting there on cash and waiting. Right? So they're waiting on cash. So eventually, though, most of those people will put that cash back in. They're going to choose where to put it.
Agreed. I guess the one thing I would say that might be a little misleading about Wells Fargo's characterization of that is clients put a record amount of cash into the market. I mean, the amount of inflows we've seen into the U.S. equity market this year is more than the entire last 20 years combined. And
right. So but they also got all this liquidity, right? They got all this liquidity.
Yeah.
and they weren't spending it at other places, but then now they're just sitting on cash. And I think one thing we've also learned is that people, they have changed, their focus on the markets. They've focused on, they enjoy it more. It's like entertainment, it's learning, right? It's part of their day. And
Totally.
so to think that that liquidity will just be completely taken away and put somewhere else, like I think that part of it will remain market related. Doesn't mean it won't go into bonds versus equities, but I think that there has been a little bit of a sea change on the wider range of people, who are more interested and focused on and involved in the markets.
Totally, totally. And that's why we're here trying to help. This is the passion of ours, and certainly something we'll be doing for a long period of time. I do, I fully
What?
expect there'll be a time. Who knows when it'll happen? But I assume maybe it'll be mid 2022, maybe middle next year, where the TLT is outperforming the SPY by like 1,000 basis, or not 1,000,
Yeah,
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 1,000 basis points. If not more than several, it could be a couple thousand basis points.
yeah.
And so, one thing we know with this, particularly this newer class of investors, because there's I think you almost have to separate your baby boomer kind of retirement, near
Sure.
retirement type investors that maybe a couple $1,000,000 or something like that, from your YOLO, Reddit hood, Robinhood, or whatever websites they're looking at. That's a very serious incremental new component of the market, because what tends to happen is that they tend to exacerbate momentum in both directions. And so like that's an interesting dynamic where, will these people take the TLT and take it to a price that it doesn't make any sense? I hope they do, because we're going to be longer.
Switching gears, because this is
Yeah.
the second one that I was flagged, and it was one of the first questions that actually came in from Robert. With China holding strong, are there other regions in the Asia Pac region they're also watching for possible allocation? And then, I'm going to move down here. Joel Garten, am I reading the GNI projections for China correctly? And the first quarter could end up Goldilocks for them before reflation thereafter. I think it's getting around timing, right? I think we've
Mhm.
seen the technicals look better right now for China. And you even mentioned, I don't know if it was today or what morning note, that, even with some like not great data, markets are holding in there. So kind of
Yeah.
like, are we hitting a bottom here, and are we going to start to see the benefits of the macro improving?
Yeah, no, I think we're still quite a few months away. Not quite a few, that's a mischaracterization, but we are 3 months away from today for the bottom, or at least where our model's projecting the bottom in Chinese growth. So that's March of next year.
Yeah.
The one thing that got us to buy China, I'm blanking on the week, maybe it was 2 weeks ago. One thing that, or sorry, on the 7th, was to say, we started to look at the signals and say, look, the KBA is not treating this like it's worried about these next few months of slowdown. It's
Yeah.
treating it like we're getting towards the nadir of that cycle. And part of the reason
Yeah.
it's starting to treat that, in our opinion, is the easing cycle in China is now kind of kicking back into gear. You're now starting to see them cut a sort of a triple R. They cut an incremental 50 basis points. You're now starting to see them sort of, I wouldn't say talk up fiscal easing. That I think that the investors, Wall Street has ran too far with those headlines, but they're certainly more amenable to it in terms of being more open and honest about their pledge to support growth. So I think that Wall Street has taken that a step further and said, okay, well, if they're pledging to kind of put a floor on growth, then they're going to have to do something to do that. And so I think there's obviously a lot more speculation about the fiscal monetary easing initiatives that may come out of China in Q1, and that's maybe what the markets are front running.
So we hit it early 2020, 22. They're asking about risk ranges and when you might learn more. And I'd say that early in the year, you're going to learn more.
Absolutely,
Is that
absolutely.
fair?
They
Um,
they are coming, and they are incredible.
and I'm just going to scroll down here. We've got a new member, Lewis P. And he said, how do I read your slide reviewing the options market? He said, divided in the grid. Specifically, what do you mean with TLT and correction probable? Thanks, LP.
Yeah, that's a great question. So, taking it to the chart here, this analysis is designed to characterize how investors in the options market are positioned, both from a medium term perspective, that's on the x-axis through the lens of skew, and on the y-axis from a near term perspective through the lens of the volatility risk premium. And so, what we're showing in this, what the TLT, where it is, it's saying, hey, look, investors in the options market on net are a little bit more bullish on TLT on a 3-month forward basis in terms of skew than they have been over the last year. And oh, by the way, their volatility risk premium over the near term is actually negative. So medium-term investors have shifted to getting incrementally bullish. They're not very bullish. It's 0.5 z-score, but they've gotten incrementally bullish on TLT in the same sense that sort of near-term investors or people who are managing shorter-term risk are very clearly not signaling or not anticipating incremental volatility in this asset. If they did, you'd have a volatility risk premium as opposed to a discount. So again, the premium and discounts relative to near-term realized volatility is denoted as in our chart by the mean of 10-day, 20-day, and 30-day realized vol. And so when I say correction probable, it's because the positioning in the options market has gotten to a state that may suggest it needs to unwind a bit to kind of balance things out.
And we've got another question. It's not the same, but related in terms of understanding grid from Josh. And can you explain why slowing growth, so I think he means decelerating growth in GDP, is so much more important to assets than a historically strong consumer and very strong economy? And those are obviously like his points here, not mine. But it's hard to understand why consumer-facing sectors would perform poorly. Is it a valuation thing? Thank you so much for all you do.
Yeah, no, that's an excellent question. It's not that consumer-facing sectors are just going to perform poorly. In fact, if you see in inflation and deflation, it's neither a top five nor a bottom five sector. Consumer discretion or consumer discretionary is top five in deflation. And so it's literally, there's 11 sectors, so it's literally the median sector in inflation. And so it's not that it's good or bad. What matters is the rate of change of the dynamics. And generally, what's speaking is the market wants lower beta, more safety, higher quality exposures when growth is slowing. I don't know why it does. I don't think anybody knows why. I just think, well, actually, no, we know why. It's prospect theory. Go read Thinking Fast and Slow by Danny Kahneman and Emil Tversky. That'll tell you everything you need to know why rate of change matters so much to financial markets, because it's not about the outcome in terms of how human beings characterize whether something feels good or feels bad. It's about the path they took to get there and whether or not it was better or worse than what they thought was going to be the actual outcome. And so that to me is
the playbook that we've looked at in the past is that the other element that does not do well is leverage. So, and the mark is about 2.5 times. So even if you're in a highly levered industry like real estate, a lot of REITs have a ton of leverage, that anything above 2.5 times tends to underperform in market downturns that would be in that deflationary environment. So if you're going to have a risk-off environment, leverage, even if rates are going down, because that's what it implies when you're going to have the growth of inflation decelerating, they don't do well because they act more like a high beta security. So the only other thing I would add here that you should be careful of, although it doesn't tend to be a real problem other than in certain industries and discretionary, is making sure that when you're picking securities in some of these sectors that we're looking at, the factor exposure of leverage, it's really not a relative thing versus other folks in their industry. It's an absolute level. Be very careful with. And I'm not saying that we're calling for a correction. It's just if you have a choice of two things you like equally, pick the one with less leverage.
Part of the reason the high beta backtest does so well in Goldilocks, it's the best performing equity style factor in Goldilocks. It's the second best performing style factor in reflation. And conversely, it does so poorly in inflation and deflation. It's the worst performing in both those two. I think it's because of leverage. Like leverage amplifies your returns in both directions. So if you're a levered company and things are improving economically, you're going to generate higher earnings and higher cash flows than an unlevered company, all things being equal. Same thing works in reverse. And so clearly when growth slows, investors start to reduce the multiples they assign to these kinds of businesses because their terminal downside for something like earnings or cash flows is much bigger, it's much greater.
Right. So it's here. And what are your thoughts on investing with leveraged ETFs from KT?
They're a good vehicle for an inflation or deflation environment. Therefore, you're probably never going to see me buy. If I could find a way to buy a levered TLT ETF, and I'm sure that somebody will send me an email on it. If there are, then yeah, there are times where
I think there might be one. I think I looked into stuff before, but KT, and we sometimes use leverage ETFs, and we don't go really the high leverage ones. Let's say you were in something like a 1x leverage tech short ETF. Like we have some clients who just can't short for whatever reason, but they don't mind us getting an ETF that has a short position through it. And then you get a loss, and these are tax paying clients. Maybe you'll take that loss so you can tax harvest the loss, make the position smaller, but by, for a short period of time, that 1 month window, a leveraged ETF, and then you could unwind that and go back to the one you wanted in the first place. So one thing you can do to manage taxes is as long as it has enough assets in it, in terms of being a liquid security, we're fine with it. But that's like our second preference versus the first preference. But we do use them in that case.
And I'll definitely add on that. I don't mind if we feel we have a lot of confidence in the regime. Let me go back to slide 26. There are times where it's very clear and obvious to use leverage. You can be levered long TLT here, be levered long IWM here, or sorry, SPY there, be levered long NASDAQ and IW, be levered long all these things when the market regime is so clear and obvious. And the reason the market regime was clear and obvious back in those economic states was the actual economic regimes themselves were clear and obvious. There was a 95% conditional probability you were in deflation in May of 2020. It's very obvious,
Yeah.
Like there's a greater than 70% chance that you were in inflation.
You're gonna be okay. Yeah.
Except for these 2 months. But when you're in this grid zero hodgepodge, it makes it very difficult to want to assign an incremental leverage to a position because we're dealing with a lot of sort of non-trending leadership in sector and style factor terms. I think it'll be a very appropriate time once we get into this part of the game to be levered long things like TLT and gold and US dollars. But right now, it's really just about making sure your leverage according to not only just the regime, but also the depth that you are in the regime. The further you are into the regime, the more leverage you can apply in terms of the positions that work in that regime.
We have an interesting question from Roy Nasser here. We have a new, I think, lower level LL on FM, IWC, OEF. They're wondering, is there a liquidity issue at the margin or what's going on?
I don't have my model open, and I'm sure it'll crash my computer if I try to do this all at the same time. So let me just pull it up on Bloomberg. So Frontier Markets, IWC is microcap. So let's check Frontier Markets. Yeah, Brazil is keeping me up at night. I'm sure everyone's enjoying that this week. Like, why did I buy Brazil? So new lower low in Frontier Markets. New lower low in microcap. Let me guess. I'm guessing my friend Ark. I actually like Kathy Wood. She seems like a really nice person. She's having a tough year, but she's had a great last few years.
Just the wrong vehicle.
Yeah,
I could see her if she had like locked up capital for 3 to 5 years. That's what at our former shop. People don't give you that anymore. But if you, can take that longer bet and have more of a lockup, then it's obviously more. It's more helpful for someone like that.
Everybody crying for Kathy. She's a billionaire.
No, I know. No, but I'm just saying, like, and also as a shareholder, I'm not a shareholder, but if I were, I'd be pissed, right? Because you might be a believer on a different horizon than other shareholders. And so you're better off buying the underlying in many ways than buying that security when there's risks like liquidity risks like we're seeing right now.
Well, and I think part of it too is just aligning your marketing message with your customers, with your, this goes for any business, our business, your business, any business.
But someone else is going to be trading off of it, right? That's the whole point of the trading ranges. Like you invest in something for, and this is something we talk to institutions about, like why do we have a third step of our investment framework? It's like, well, because you think you're trading based on some, wonderful fundamental view. And you have these, due diligence hurdles, and that's what you're checking to be right. But then someone else is trading it for a totally different reason. Like they're shorting the ARK or, whatever it is, or shorting your Australian utility for a totally different reason. So unless you really are seeing how things are trading, there's always going to be different people who enter that security for different reasons, different time horizons. And so you have to be more careful to understand, well, how many of those people who don't think like you are affecting that security? Because otherwise you can't use it then, because you're just not going to get paid on your beliefs.
And that takes me to another point I want to make. And this is the point I've been making the last few around the horn, certainly a point I made in the last two macro scouting reports, which is these numbers are really high in the context of our trend growth rate. Yeah. The U.S. in terms of potential GDP, the growth rate of our labor force, the land labor capital in the society that we have, unless we have some sort of like magical productivity boom, I struggle to understand how we're going to grow faster than our, like almost doubly as fast as our trend growth rate in the absence of
Sure.
negative comparisons. Like not
Right.
only do we have the lapse of negative comparisons, we also have the advent of what will be a pretty material fiscal drag from our perspective
Right.
relative to fiscal year 21. And so my the reason I bring this up is in terms of like different market schools of thought with respect to asset markets, which is there are some people that will look at that and say, well, US is growing above trend, therefore things are fine. You need to buy more
Yeah,
stocks.
right.
Quite
Yeah,
frankly, I think we have
we
a lot of
have
that.
research from a group, a really smart group, and that's their
Yeah.
point. But it's like, yeah, but it's decelerating. The growth is decelerating, so the second
Yeah.
derivative doesn't look so good.
Totally. And I think both of those sort of research schools of thought will come to the same conclusion that if you're going from high to medium, you want to be low beta relative to high
Yeah.
beta. But if you're going from what we might differ is if you're going from high to medium and that delta is really big and it happens over a short period of time, stocks can crash on that, is what we'll
Yeah.
say. Whereas I
Yeah.
think that other group will say, no, that's not necessarily the case.
Yeah, and there was an interesting study that that I redid with some data from Goldman. I think I mentioned it before on this program, where they took the grid that you have, and then they
Mhm.
also looked at what does it look like when the when you have some of the
Pretty
like
mild, right?
PPI and other things, above a certain level versus below. There's ISM is like above a certain level, below a certain level, and it ends up to be 53. It's not 50, but it's 53. But I like to
Yeah.
look at 50 to 53 as well. But
Mm.
above that, and it can be declining. So it's not the growth decelerating, but declining at that level, and you can do okay. But once you start to get south of 53, and we're not anywhere near that with the ISMs.
No, we're not.
But if once you start to get below that, then any kind of declining numbers can really pull you down. So that's another thing that I take a look at. And we're not hitting that threshold, but obviously we'll be declining. And
Yeah.
so, once you get close to that, you have to be much more careful. To say like, okay, the inflation or the changes in inflation growth are going to matter more. The changes in GDP growth are going to matter more. Well, it's
Yeah.
about the ISM levels and where you're at. So just another thing to think about is, people are trying to thread the needle here. Is there's obviously the trading element, which is the question about the trading ranges. There's the macro questions, and then there's just like, when's the timing of this? How do you decide to shift? That's just one more tool to use.
Analysis and I think that 53 level probably coincides somewhere around where the trend growth rate of the economy is. So
Yeah.
you start to slow below trend and spook people out because people start to think about recession fears and all those other
Right.
things. And when you're above trend, it's a more manageable slowdown that you can sort of hide out in lower beta securities. You can hide out in. So when you go below trend, that's where the hiding out starts to get nervous and people start pulling money out of the market. So I tend to agree with that kind of analysis, which is why I'm saying, hey, look, can't wait to buy the dip in utilities, why to buy the dip in REITs, buy the dip in consumer staples. There's a lot of stuff we're not long yet that I want to be long, heading into next year and really, persisting throughout most of next year. So that's definitely if we thought we were going to slow, if I had a ton of confidence, and I don't have a ton of confidence now, but I tend to lean in the camp of where I just started, which is the U.S. is a 2.25% economy. What's causing us to grow 4% next year?
Yeah.
If I start to get incremental confirmation that we are going to grow somewhere close to 2.25% and growth expectations need to come down by 150, 200 basis points, then I will be not buying the dip in consumer staples, not buying the
Yeah.
dip in
Yeah.
REITs and utilities because they'll go down in absolute terms. So that's probably it.
No, then one more question from Robert on Brazil. So he's saying, with their easing monetary policy, how do you view the small cap sector such as EWZS?
Yeah, no, I don't want to be long anything small
I'm
cap.
like, I can answer that, but I'll let you answer that, right?
No, that's a pretty easy answer for me. So I mean, and to be fair to the nature of the question, Brazil in and of itself is a high beta asset. So I sort of violated my own rule and am paying the price for
Right.
it this week. In terms of not being long that kind of security.
You're the only one who ever violates their rules. I'm just kidding.
No. No, rules are meant to be violated. That's why we create them.
Well, you have a process, but you're also a human being with a process. And human beings sometimes say yes, but like there's this other data point, right?
Yeah.
And so
totally.
we all know it's probably best to always just follow the structure, follow
No.
the process. But sometimes the other things, they
Yeah. Well, part of that process was looking at the EWZ chart and saying, hey, look, we
right. Look
just
at the data. Yeah.
EWZ. Go give me my pin out for this chart. Here we go. EWZ literally didn't know that there was a correction starting in Black Friday. Like it was
Yeah,
just
it's
like,
true.
ah, whatever, I'm
Yeah.
chilling. And then all of a sudden, out of this week, where Sir Kensington said, "I'm out of high beta," it obviously made a pretty dramatic
Pretty big.
decline
Yeah.
to a new low. So I got to see how it trades over the next few days, maybe into on the other side of OPEX this week. This is not an asset I'm going to feel comfortable holding if it doesn't recover very quickly. So be aware of that.
Sure. Thank
So
you,
with that,
Wayne. Wayne links my
yeah,
art. So appreciate that, Wayne.
Wayne, you have
I was
what,
looking for
Wayne?
something happy, Wayne. Everyone
Yeah,
in my home office and probably most places it's very dark and wood and in New York there's a lot of those like foxes jumping over a fence and that kind of stuff.
yeah.
But
That's why we
anyways,
make such a good team because you have beautiful art, and behind me, I have a picture on that play in this picture. The guy wind up blocking gets thrown out of bounds into the Gatorade, and so that's very opposite of very happy art. But that's why we make a great team. So we appreciate you guys. Everyone have happy holidays. We'll be back here next Wednesday and the following Wednesday as well. For those of you who are still bolted to your chair, but for those of you who aren't, we appreciate you tuning in and happy holidays. Thank you.
Bye bye.